The only school that teaches you about money is the School of Hard Knocks. Until now.
You need to learn this business, and this is the time to do it.
Become an insider, so you have to know the rules before you get in the game.
Welcome to the Money MBA Podcast.
Oh, have I got your attention now?
Where you'll learn how to be a master of money.
There's so many ways to make money today.
Let me show you in 2 seconds flat why the rich get richer and the poor get poorer.
Now here's your host, Jon Kutsmeda.
Hey everybody, welcome back to the Money MBA Podcast. My name is Jon Kutsmeda. Now, it has been a little while since I've recorded for the Money MBA, but I felt inspired this morning after listening to a conversation between Corey Hoffstein and Jason Buck on the latest episode of their show, Pirates of Finance. It got me thinking about a conversation I had on the Money MBA a few years ago with none other than Michael Green. Now, both clips I'm going to share with you are about the same topic, gold, and both conversations share a similar perspective. Now, the debate around what is gold and what is money is probably one of the most fierce in finance. And hopefully, both of these clips will bring some fresh conversations to the debate. So without further ado, enjoy this clip from the Pirates of Finance, very quickly followed by the conversation I had with Michael Green, and let's see what we all think gold actually is.
And gold's up like 8.5%, 9% on the year from the lows in November. It's up 20%. It's peaking towards all-time highs. I want to get your thoughts on gold. Do you think it's something that should be a strategic allocation in a portfolio? Is it a tactical allocation? Is it actually an inflation hedge? Give me your hottest, spiciest takes.
So many things on there. One, just to give context too, what did you say year to date? It's about 8.5. Is that right?
I think I was using the GLD ETF.
I'm looking at the future. I'm looking at the futures. I think it's up 8.5. And speaking of, we're back. Bitcoin year to date, it's up like 68%, and Ethereum like 50% on at least the future side. So I've said it before, like, I don't understand what gold is. I've been trying to think about this for 2 decades. I'm not so certain. Historically, like we've talked about before, it is a hedge, right? But not in the years that you want it to be a hedge, or the quarters or months that you need it to be a hedge. And as you've talked about liquidity cascades, like a March 2020, everybody throws out the baby with the bathwater. Everybody's just trying to raise cash. So they're even selling their gold positions there. Historically, people have talked about, the suit of armor versus a bespoke suit today, but it doesn't necessarily cover you in those intervening years. Is it a form of inflation hedge? Sure. Is there higher betas to inflation with commodities? Possibly. I'm not so certain, but I still think it needs to be part of our portfolio. Trying to think of what I could say publicly. We have it in our cockroach portfolio because we view it as like a fiat hedge of like, what if, markets shut down like they did after 9/11, right? Like you want some gold. Not only do we use gold futures, we use physical gold as well. And man, it is comforting to have that physical gold when SVB was going on. I'll just put it that way. But then the question is like, what are you going to do with those kilo bars of gold? Right? Are you going to shave them off? No, like we've talked about before. It's like you're just, you're hoarding supplies for, the latest, Blackwater ban that's moving through your neighborhood. So I'm not sure, like if it seems to be a long-term inflation hedge. It seems to be a long-term purchase power parity hedge, but it doesn't seem to be those things when you want it most, which makes people rip their hair out and say it's stupid or it's never going to work, or the hate on gold is like right up there with crypto.
I find gold to be fascinating. There's sort of two things I'll bring up here. The first is from a historical context. I wonder how much of our continued belief in gold is just long-term cultural memory. Right? Gold, when you think about the way currency was created thousands of years ago, gold was sort of the perfect metal to work with, right? It's scarce enough that people can't just go easily dig it up. It's malleable that it can be made into currency, but not so malleable like silver that it's too soft and breaks easily. It doesn't have a ton of industrial uses, so it could be primarily put towards being a currency. And then look, if you're a government that sort of de facto institutes gold coins as a tax, gold becomes money, right? in my view, the thing that is money is the thing that your government taxes you in. That's ultimately what you have to earn to make sure that you pay your taxes. And so there you go. We get money, and gold sort of fits perfectly in this triangle of things we need. That's why it's not palladium. That's why it's not silver or other precious metals. That's why it's not steel. That has since changed over time, but our cultural memory goes back thousands of years. It's not a super stable store of value, but if you are not a U.S. citizen and you go to a different point in time in history, and you're talking about being able to physically transfer some sort of value. Like, does it really matter if gold goes up or down 20% as long as you can get some of your net worth out of a country if you're fleeing or avoiding local hyperinflation? Like, as long as it's accepted worldwide, I could see it having value. It reminds me of a story a friend of mine told me who was in the special forces, and he said one of the things he was taught was that when you go out in service, having a Rolex watch is sort of the equivalent of being able to get a low-end car anywhere in the world. Like, if you need to escape, that Rolex watch on your wrist will get you a vehicle. And I sort of think of gold the same way. Like, there's no cash flow. There's no reason it should necessarily go up. I can't make a strong argument why it's tied to real rates other than people think it should be, right? But it seems to at least have some modest store of value for folks in the short run, especially if you consider a considerable amount of local volatility. If the US dollar suddenly exhibited hyperinflation, gold might be a tremendous store of value. I don't know.
Well, I love how carefully you're choosing your words, which is great. By the way, in the comments, Sean said, gold is money, everything else is credit. You know, that the Austrian perspective. Yeah. But at the same time, like, I was watching this thing Steve Keen the other day too. Is talking about like all we are is like exchanging bank liabilities. I thought that was another good way to put it. But the whole point of gold, what we're always talking about is like it's nobody else's liability. And thankfully, well, it passed so quickly, I don't think it actually worked. But the idea with with SVB and some regional bank collapses is we found out that deposits are banks' liabilities. And that's what this is why people are gold bugs. So they like gold, is they don't like it being anybody else's liability. Granted, you have other issues with storage facilities, vaults, like how are you going to keep it? Security is now your liability, not necessarily it being on a balance sheet of a bank. But
it presumes there's a buyer, right? The whole thing with gold is it presumes there's an eventual buyer on the other side. I know gold people and Bitcoin people don't always get along, but I think that's fundamentally what people argue with Bitcoin, which is, look, we've got this whole proof of work network that is doing all this work. And so long as we within the network all accept the Bitcoin from each other, then for our services and goods, then the Bitcoin has value. We've circumvented the global monetary system. Now, the question is, how big can you grow that network? You need everyone to accept it. I think most people on Earth will accept gold as a form of payment for service and goods to a certain degree. And so in that sense, it is a sort of global money of sort of the last resort, right? I don't know if you could really go anywhere on Earth and not convince someone to take at least gold as payment in some form.
Right, but it's currency. But what'd you call it? Cultural memory? Is that what you called it?
Yeah.
But also, like, I mean, I'm sure this is going to permeate the rest of our conversation, but value is in the eye of the beholder, right? And we do have a long cultural memory, so it does have those thousands of years of Lindy effects. And to your point, like, historically across the globe, it's used as as a medium of exchange, but like that's that cultural memory, and it's everything that we do that has value has cultural memory to it, right? Even our modern laws are a cultural memory from the beginnings of Christianity. So like we could kind of say that about anything. Like it's all cultural memory and a sustained global belief or disbelief in that this thing has value. And that's the point, is like, it's interesting though, that the dislocative effects when gold has high value is it cannot be cataclysmically dislocative, right? Otherwise we're talking like guns and butter time, right? It needs to be like mildly dislocative, like any sort of like diaspora or like, intermittent market shutdowns. But if things get worse than that, I'm not sure gold has that value besides, you want protein and a water source.
Right. I often hear the argument gold is an inflation hedge. I think those who first of all, we've been on this tirade before. What is inflation? What type of inflation? I'm not going down that path again. I think there are plenty of people who bought gold. Massive truck just went by. Plenty of people who bought gold in 2020 expecting inflation that then did not get the hedge they wanted. But there was this paper that came out a couple of years ago. I think it was August 2020 is when it came out. That was written by Claude Erb, Cam Harvey, and Tadas Visconta, called Gold, the Golden Constant, COVID, Massive Passives, and Deja Vu. Very long title. The idea of massive passives came about in the post-commodity boom era, when Goldman wrapped up commodities in an index. Suddenly, tons of endowments started investing in commodities. That flow of capital changed the very nature of commodity returns themselves, became more correlated with equities. There's volatility spillover effects. Commodities within that basket became more correlated to each other than commodities that weren't included. And so this idea of like massive passives, when you get too much flow into a large passive index, can change the nature of what you're actually trading. What this paper argued is that the same thing has happened with gold, that by taking gold and putting it in financial products like ETFs, like futures, it is now no longer tied to real interest rates the way it seemingly was in the past. They showed a ton of the returns are basically driven by supply and demand in the large ETF structure. That is, money flows into the ETFs and money flows out of the ETFs. That is now the primary driver of returns for gold in the short term. It's just all supply and demand flow. And again, without any cash flow coming from gold, other than like there's the storage costs of gold, that's sort of your negative carry. I'm not sure why it would necessarily be attached to economic fundamentals anyway. And I'm sure I don't think any gold bugs actually listen to this show, but I'm sure if they did, they tell me again why I'm a complete idiot and way outside my realm of expertise. But gold is one that I've always struggled with my whole career.
Yeah, me too. But we still hold some. Still always holds up, because like the whole point is like I don't even know what has value. So I just try to have a diversification of things that are potentially valuable. And it's like, pick, what do you want? I got everything. I'm selling, all these different things in the marketplace. What do you want? What has value? You were
the one who bought the Ether Rock, right? That must've been you. Yeah. You have got your digital gold and your physical gold.
No, but I thought was interesting what you brought out out of the paper, that Cam Harvey et al. Paper, is that, with financialization and fractionalization, and, does that affect pricing over time and historical representations? As we brought up, do you think it's analogous to like what I say is like housing is no longer a home? We financialize that product, so you might as well throw out 100 years of housing data because it no longer applies.
Yeah, I think that's spot on. I mean, the more something gets financialized and traded, the more you add liquidity to the system. I think it fundamentally changes the nature of the asset class. That to me was something that has been a larger area of study for me in the last couple of years of my career, and an eye-opening part of my career, where it used to be there are these fundamental factors, and not to say they weren't changing, but they were sort of constant North Stars for me. And then it came to the point that I was like, flow into these concepts fundamentally changes the concepts themselves. And I think that's somewhat obvious in hindsight. I just thought that there couldn't be enough flow into some of these ideas that it would ultimately change it. But, even look at something like equities. I think there's a strong argument that the indexation of equities, and I don't even want to go down the road of is passive messing up the market. I just mean being able to buy equities at a super low cost in a super safe vehicle that's highly liquid. Everyone's doing it in their 401k as a savings vehicle. Why would that not structurally increase the PE of the market versus what we saw back in the 50s and 40s? Right? Why would you, if it's easier to access, there's more people accessing it, more demand, not necessarily more supply. Like, why wouldn't we have a structurally higher PE? And I think just thinking through different markets like that is something I've tried to focus on a lot more in the last couple of years.
Yeah, and it's not even, you don't like that, like you're saying, let's pause on the ETF passive thesis, but like you're pointing out is like not only structurally but legally, the way they've changed the frameworks where you're forced into indexing, right, on your 401ks and everything. That's obviously going to change the markets. It's a locked in effect, as maybe like Jaron Lanier would say about, any sort of technology or AI, is like we kind of lock into these effects. So you're just forcing it through these tubes into changing that PE multiple. So I think that's a fairly salient argument. And in what you're saying about flows, to me, like that's the way I just see the world, right? Like if we just use like a 4-quadrant model, right, of the axes of growth and inflation, whether it's stocks, bonds, gold, commodities, vol, whatever it is like everything is performance chasing, and it's just flows moving between those asset classes around the world. And so that whole like equity risk premium or volatility risk premium, to me, those are always rising and falling because it's just flows that are just performance chasing around the world. And we're just playing hopscotch. It's a form of like gentrification on Manhattan, right? You go gentrify one neighborhood, becomes expensive. You go to the next neighborhood, gentrify, and eventually you end up back in that first neighborhood 20 years later. Like the same thing to me happens with just asset classes. As large money just passively flows around the world into different asset classes, depending on the regulatory environment or the financialized or fractionalized environment, that's what, moves prices. So like you're saying, if you're structurally forcing more money into the stock markets and the stock indices, yeah, I think there's argument to be had for higher multiples.
I think of gold as a very effective pricing metric for commodities. It is a useful tool as money, right, in an environment in which commodities are the base traded good, right, where you go to as an industrial provider, you're most interested in buying steel, you're most interested in buying iron or copper, et cetera. Gold is a very useful tool for thinking about pricing in that framework. And it's increasingly obvious to me that it's actually maybe not so valuable for a world in which the primary consumption is something like a Zoom video call or telecommunications that are increasingly non-exclusive because our conversation is being broken up and packetized and shipped over the internet with very few limitations in terms of capacity, right? Or capacity expanding actually faster than we are adding to it. Many people remember all the fears 10 years ago about the internet was going to run out of capacity, right? Well, now here we are, we're transmitting video all over the place because transmission capabilities have expanded, compression technologies have expanded, and as a result, suddenly something that would have been very pricey and had to be done over a Cisco proprietary system are now done for free over a Zoom network, right? I think that's one of the challenges that we have to struggle with is the frame of reference that may work for a period in time, may not for another. And exploring that and being able to do so freely is a luxury that I have, right? I'm truly appreciative of that dynamic.
Yeah, I mean, one of the things you said right there at the end is I think what I'm taking away from a lot of the stuff I'm watching you do, the presentation that I had the privilege of watching and discussing, and it's tricky here doing a podcast because I have that frame of reference. So I'm trying to cliff note it a little bit so the conversation's digestible for people listening and watching. But one of the things you just said there, you're challenging this. Very much so challenging a paradigm. Is that the right way of putting it? I mean, this historical viewpoint, even of gold, the way you question it, it makes a ton of sense where today it doesn't make as much sense, even though from a narrative standpoint it does, but not so much in its functionality outside of, working as this pricing element for commodities. So is that a big part of this experience for you? You kind of feel like it is a new world in terms of like the way certain things in the monetary system, the role that they used to play. It's just not. It's what is it, Mark Twain? It's
so
what we think we know, but what we know for
what we think we know that it just ain't so, right? I do think that's one of the real challenges, and just candidly, if you assess something like gold, it has all the classic hallmarks of an argument that Keynes described as a barbarous relic, and people of course love to make fun of that analysis. And to be fair, Keynes had a very poor understanding of the dynamic of money, or a very poor articulation of the dynamic of money. But when you think about how people defend gold, they often start with the first observation. Gold has a 5,000 year history, right? You know, in the history of man, gold is money, right? Well, that's a pure straw man argument, right? You know, you are engaged in a classic appeal to authority. Let's look at the history and the augustness, and it's the equivalent of saying the Tudors have ruled England for centuries, right? Like, it's meaningless in the current context of things, right? And the fact that something has a 5,000 year history is, as somebody else pointed this out, and I thought they did an excellent job of highlighting this fallacy. But there's a 5,000 year history of bleeding people with leeches, and we don't continue to do it. And I understand that puts me out in a situation where people are immediately drawn to attack and saying, oh, there's a failure to appreciate the history. I think, you know me well enough to know that actually I spend more time trying to consider that history and evaluate what's actually driving that narrative than most do. And that is, again, what kind of lends strength to an argument. When you can turn around and repeat the underlying argument that somebody has for why gold, right? Why is gold important? What are the historical examples that you can point to, or the evidence thereof? Those are all things that I think are incredibly important in formulating your argument. And people can be very sloppy about it, right? You see it, you don't have children, but for those who have children, and in particular teenagers, you'll see them very quickly jump to a conclusion from a set of facts, right? The classic IQ test of, Susie is a Whizbee, and, James is related to Susie, and therefore James is a Whizbee, sort of thing, right? Well, they can immediately say, yes, that's true. You're like, well, you don't know what a Whizbee is, right? Maybe Susie is a Whizbee, and that requires being a woman, and it's actually a designation, so their relationship has no link whatsoever, right? I would just argue that kind of becomes the most important part. You need to understand your opponent's argument probably better than they do. And you also need to free yourself to make mistakes and think clearly and be unfailing in kind of pulling the thread on that sweater until there's no more sweater left. So.
And I also think your approach, though, is you're not, although I think maybe a 40,000 foot view may judge it this way, but you're not trying to win the argument per se. Like, yeah, you want to have that strongman approach so you have an intelligent debate about it and kind of get somewhere that's productive, but you're not going in at, I'm right, I have to win this, and let me beat you up at every corner.
It's actually really funny because the worst arguments I'll have with my wife, or she'll say something along the lines of, it's impossible to argue with you. And I'm like, we're not arguing. I'm not actually arguing. It is inconceivable, right? But we'll have a quote unquote argument from her standpoint where I am questioning something that she is saying, and I'm legitimately questioning it. And I'll say, I don't know the answer. I'm just exploring it. She's like, well, why can't by refusing to accept what I'm saying, we're having an argument? No, Jon, we're really not having an argument. And I'm fortunate that she's been willing to tolerate that for 20 plus years. But
I feel for her.
Yeah, I know, but almost anyone who knows me does. But
so look, this presentation you did on gold, it's again challenging some of those paradigms. You're not seeking conflict. You're seeking, a contrarian pushback on it. And one of the things I thought was so unique in terms of making your point why maybe gold is a bit of a relic is that you kind of went through this whole process of, it just happened to be in the right place at the right time, right? You kind of had the periodic table and you crossed out all the elements because they were either, toxic or, you couldn't really work with them. And you were really left with a handful of them. And the ones that weren't, incredibly rare very quickly, took the role of playing money. And so to your point, 5,000 years later, we're still kind of holding on to the fact that, it had all these magical properties when really it was kind of more of the right place at the right time.
Yeah, I think that's right. I'm actually happy to share the slide if your viewers would be interested in it.
Go ahead.
Let me. Do I have the ability to share on the screen here?
And if not, I can just.
Yeah, why don't you enable it quickly? So this is the slide that I shared at that meeting, and it's asking the question, like, why did we actually choose gold? Why was gold chosen? And more accurately, why was a gold silver alloy chosen as the first, what was referred to as electrum? Why was it chosen as the first? Hold on a sec. My son is trying to sneak behind my green screen here. Not very well, he asserts.
He did. There was no conquering of Rome on the blue screen.
No conquering of Rome on the blue screen. No, that's Marin County there. So, the question of why gold, well, the dynamics of, if you think about what was needed for coinage at the time, and coinage was really just a system of accounting, that if you think about, and I have this slide elsewhere in the presentation, you're familiar with this, what money is really about is the cancellation of debt. It is a uniform vehicle that allows you to assert, I have paid my debt, and it is no longer held against me. And that's the value of the state, is providing the resources and reinforcement around that. A court system that says, yes, you've paid your debt. Here's the demonstrated dynamic associated with it. And we will defend you against the depredations of a mafia or someone else who asserts that, yeah, sure, you gave me something, but it's not enough, right? Like, those are the systems and roles of the state government. In terms of why it became gold, well, look, what are the key criteria when you think about trying to create coinage 2,000 years ago, right? And even today, for that matter, it needs to be solid at room temperature. And so if I think about things that are solid at room temperature, let's see if it's gonna. Solid at room temperature wipes out all those elements on the periodic table. Can't be radioactive, because that would actually be a fairly poor feature of coinage that you're holding in your pocket. Likewise, it can't be corrosive or toxic. That might improve the velocity of money if it was toxic, but that's really not the objective here. You want to have something that you can physically hold and, again, keep in your pocket. And then there's something that people tend to forget about. So now we're basically down into the metallic compounds, right? The simple metallic compounds, everything from magnesium to cobalt, et cetera. And it needs to be malleable at achievable temperatures given the time period. So sure, we could mint coins out of tungsten today if we wanted to. And most people are going to be familiar with the fake gold that was uncovered in July in China, the roughly 83 tons that turned out to be gold-plated tungsten. Was it tungsten? I think it was tungsten, which has a similar atomic weight to gold. And so it weighs roughly the same and can be confusing in that framework, right? It doesn't look anything like it. Well, tungsten requires melting at roughly 3,500 degrees Celsius, right? That was not achievable 2,000 years ago. Mm. And so if you go down to things that are actually malleable at temperatures that can be achieved with an oxygenated furnace, you're basically down nickel, copper, zinc, silver, and gold, right? Every single one of those is used as money all over the world. Alloys of them, occasionally tin will get tossed in there as well, right? But that is what it is. And then it just becomes a question of, if you're going to use it for conducting international trade or large-scale trade, it can't be a complicated alloy, because you need to be able to test the accuracy or the fineness of it to confirm that it hasn't been counterfeited. And in that framework, you're effectively locked down to basically two elements, right? Silver and gold. And so we think that there is this giant magic component that, the Lord has come down upon us and bestowed us with gold to function as our monetary system. That's not what it was. It just didn't do that. And so if you go back and you challenge that very basic assumption, then it becomes a question of, you're now freed to start saying, well, what actually is money? If gold is not money, what is money? And my conclusion, as you know, is just very simply, money is that which cancels debt. It is that which allows me to demonstrate that my obligation to a fellow citizen or another trading party, a counterparty in a trade, has been satisfied. And the minute you do that, and you recognize that, right, which links itself back into the framework of what is the actual role of gold, what is the role of monetary systems, it's in maintaining social stability. It is giving you the tools to demonstrate in a trustless environment that you have performed your obligations. That's all it is. And so now you can begin to evaluate the claims that Bitcoin is going to be money, or that Bitcoin is going to be the store of wealth. And unfortunately, it just doesn't work because where Bitcoin's big failure is actually in the social construct layer. And there you find all sorts of challenges that exist for those who hold Bitcoin, or for those who think that Bitcoin is going to be broadly adopted. One of the most obvious ones being the limitation on supply. And so Bitcoin was very specifically created to prevent the flexibility or the printing of money that was done in 2008, right? Satoshi Nakamoto came out, or Satoshi Nakamoto, I'm sorry, came out in 2009 with his white paper, specifically reacting to that dynamic and the sense of violation that it created for them, right? And so they created a perfectly scarce vehicle. The problem is perfect scarcity is not a feature, it's a bug. Because ultimately, if the role of money is to settle social obligations, if you construct your money without the elasticity, and I want to make sure that people understand what that term is, because when I go to crypto Twitter or I have conversations with people who are Bitcoin maximalists, they tend to think that flexibility or elasticity is referring to, can I divide it? Can I take a single Bitcoin and split it into X number of Satoshis so that it can be spent, and then even smaller than Satoshis? That's not what it's actually referring to. Elasticity means that the supply is capable of expanding. It's capable of expanding to offset permanent loss, right? So when a ship sinks at sea and the gold is lost, there is an immediate hit to wealth and there's an immediate hit to the supply of gold. But the social obligations associated with that, the need to repay debt, really are unaffected because we know that we have a social construct. What we're actually settling with is not gold, but with money, right? And so the flexibility of a dollar to expand to offset credit defaults, offset losses that have been created by malinvestment is really important. It prevents windfall gains to those who don't take risk. So just imagine in really simple terms, Bitcoin is supposed to have 21 million coins printed in total that can be divided into any number of subunits. Somewhere in the neighborhood of 3 to 4 million of those have been lost, right? Now that has created a windfall for those who continue to hold Bitcoin, right? By doing nothing, they have gained at the expense of the rest of society. Likewise, those who lend Bitcoin, if they lend it to somebody who is of poor credit, if they make a mistake, right, their losses are absorbed by those to whom the credit has been paid out. But if that is actually lost, right, so if I lend it to somebody who forgets it in a taxi, that taxi gets recycled, the recycled taxi destroys the hard drive, or I lose the keys, right? That creates a windfall for the remaining holders, and that discourages risk-taking. The whole point in society is that we want to build a system that encourages risk-taking, not rampant speculation, which is what the Federal Reserve is engaged in protecting, right? We're going to protect against any losses by the corporate class, by the elite class, by those who have access to the regulatory framework to say, hey, we need to be protected because it will create social disruption if we experience losses. That's unquestionably evil. I'm not arguing against that. But Bitcoin is actually too good at it. By taking it out of the hands of human beings, you cease to have the monetary system function on behalf of human beings. And that's not a system you want to live in.
So it's again, a lot of times when I'm listening to or reading things that you put out, it crystallizes a lot for me because I've had so many doses of these ideas, or so many conversations, right? So it starts to become very supplementary and cohesive for me. So to take it back a little bit, one of the things that, I mean, you kind of covered, as you're talking, there's little things that came up that I was going to kind of lead you towards, and you kind of covered it anyway. But one of the things I really want to focus on first, there's actually two things. One is kind of lean in a little bit more on your definition, not your definition, but how you see the definition to be of money, because it's super important. And the first time, I had a conversation with you about the shortcomings, let's say, of Bitcoin was around this time last year in London. And it was very much about the ability to use it to extinguish debt, right? And that continues to be a conversation and a debate you have with people. But, talk about how you see, the true definition of money. And also the point you really hit on there on the end is this almost criminal behavior from the money makers, from the central banks, where Satoshi and Bitcoin and the Bitcoin, the crypto religion that is kind of developed is so much so because of the abuse of that power, right? The abuse of the privilege to kind of make money elastic has created, caused the pendulum to swing so far the other way that it's they want this ultimate perfect scarcity vehicle.
So I think there's almost no comment that I can make about that, because you kind of perfectly nailed it, right? It has absolutely been an abuse of the system. And like all abuses or excesses, it engenders a blowback or, a shift in the opposite direction. Part of what I'm increasingly taking the role of is trying to explain to people that what they have fallen prey to is swinging too far in the opposite direction in a manner that will actually have incredibly catastrophic outcomes for society, right? The general idea of hard money, right? The view of hard money draws from the Austrian school of thought. And, many of the luxuries that we have about thinking about money were actually created in the 19th century, right? So, what is money? This kind of deeper philosophical question about it. The reason we actually began to think about that is until the expansion of the globe with the discovery of the New World, and apologies to the woke dynamic of, highlighting that framework. But until we entered into these very long logistical chains, right, where we had product coming from China and product coming from the Caribbean and product coming from the New World and product coming from XYZ, the vast, vast majority of trade was conducted locally, right? It was the local baker making your bread. You would pay him by saying, I will gladly pay you Tuesday for a loaf of bread today, right? That social contract was enforced by the local lord, who would sit in judgment and say, this is what's going to happen, right? The abuse of that system, the lack of fairness that is created because of the personal relationships of that lord, are what gave rise to things like the Enlightenment period, the theories of John Locke and others, and ultimately manifested itself in the US Constitution in the right to have trial by a jury of your peers, right? Not by a lord, not by the president, but by a jury of your peers, people who could be sympathetic to the events that had transpired, right? And some of the most notable cases in US court history are precisely those juries refusing to honor the request of the crown to stick by the letter of the law and prosecute somebody in some way, shape, or form, right? That human component, that compassion, that social contract that we enter into, that's what we were looking for. We were looking for a reinforcement of that, right? When you think about what money actually is, right? That agreement with the baker that I will gladly pay you Tuesday for a loaf of bread today. I obviously stole that from the Wimpy in the Popeye cartoon. I will gladly pay you Tuesday for a hamburger today. There's a great graphic online that I've included also in the presentation, which is showing Ronald McDonald and Burger King and Jack in the Box, beating up on Wimpy and being like, it's Tuesday, motherfucker.
Where's my money?
Where's my money, right? Well, the reason that you want money is that is how you settle that debt. That is how you demonstrate the proof of that obligation. That's what's printed on the currency. It says, this is for the settlement of all debts, public and private. Right? And that's what a nation state is. That's what a fiat currency is. It is an accepted and unified framework for settling that debt. If you do not have it, the innovations of the 19th century were largely around saying, what do you do if somebody can't pay this back? right? It used to be that they would be thrown in debtor's prison until somebody who cared enough about them bought them back effectively out of slavery and said, I will pay their debts, right? Modern bankruptcy codes introduced the idea that that could be settled by placing the blame on the creditor. The creditor should not have taken that undue risk, right? What does that do? That encourages risk-taking. That encourages somebody saying, you know, I've got a great idea. I'm going to give it a shot. And worst case scenario, I'm going to have to settle my debts. Right? That was what the introduction of limited liability in corporate form did. It changed equities or investment from an obligation for both losses and gains into a limited investment, effectively a call option on upside. Again, encouraging risk-taking, encouraging innovation.
Thank you for listening to the Money MBA Podcast with your host, Jonathan Kutsmeda.
It's also my pleasure to see to it that decent, hardworking people in this community aren't robbed blind by a pack of money-mad pirates.
To access more great content, visit us online at moneymba.com.
That's where the money is. And more than that, control.
There's only one person in the world to decide what I'm going to do, and that's me.
And I am deadly serious about that. That's it, I'm done.